Monday was the kind of day that looked calm from the headline and felt less calm underneath. The S&P 500 closed at another record, so did the Nasdaq and the Dow. But oil jumped nearly 6%, and bond yields moved higher before pulling back. The reason? Iran reportedly halted ceasefire talks with the United States, and markets reacted the way they usually do when the Middle East gets louder. Oil up, bonds down. The question now is whether equities can keep looking through it. Here are the numbers. The S&P 500 gained 0.26% to close at 7,599.96, a new record. The Nasdaq added 0.42%. The Dow rose about 46 points, or 0.09%. All three set new intraday highs. West Texas Intermediate crude closed at $92.54 a barrel, up 5.93%. Brent closed just under $98, up about 4%. The 30-year Treasury yield moved briefly toward 5% before settling back below it. Not a chaotic day, but not a quiet one either. The catalyst was specific. Reports indicated Iran stopped communicating with United States officials working on a ceasefire framework. That sent oil higher on concerns about supply from a region that still moves a meaningful share of global crude. The move pushed Treasury yields up several basis points intraday as investors repriced inflation risk. Stocks hesitated, then recovered as tech momentum reasserted itself. The market's conclusion for now, a one-day ceasefire scare is noise, a prolonged breakdown is different. The deeper issue is that rates were already at uncomfortable levels before today. On May 19th, the yield on the 30-year U.S. Treasury hit approximately 5.2%, the highest reading since July 2007. That matters because the 30-year yield is the long-term borrowing rate for mortgages, corporate expansion, and long-duration equity valuations. When it moves to 19-year highs, the math on future earnings gets more expensive. Adding to the pressure, April's producer price index came in at 6% year-over-year, the steepest annual increase since the energy shock of late 2022. Inflation at the producer level has not gone quiet. The bond market is not alone in thinking rates could go higher. A Bank of America survey of fund managers found that 62% of respondents expect the 30-year yield to reach 6% within the coming year. Only about 1 in 5 expected yields to fall back toward 4%. That is a clear majority of institutional money building for a rate environment that would meaningfully reprice risk assets. It does not mean 6% is coming. It means the people managing the largest pools of money are positioned for it. So why are stocks at records? The earnings case is real. Goldman Sachs raised its year-end S&P 500 target to 8,000 in late May, citing roughly 24% earnings growth for the index this year. And the spending behind those earnings is not narrow. Denise Chisholm at Fidelity argues that capital spending relative to sales is accelerating across all 11 economic sectors, not just tech, and the aggregate capex to free cash flow ratio remains well below the 3.5 to 4 range seen at the 2000 bubble peak. The market's argument is that earnings are growing fast enough to absorb higher borrowing costs. So far, the data is not contradicting that. One part of the picture that does not get enough attention is how some of the AI infrastructure build-out is being funded. Patrick Boyle's analysis points to a pattern where AI infrastructure debt is being moved into special-purpose vehicles funded through private credit. These structures let companies keep leverage off their balance sheets. The risk is that it becomes harder to measure true corporate exposure when the credit is sitting in private vehicles rather than on public financial statements. Higher rates make that less comfortable, not more. One of the most discussed retail names right now is ASTS SpaceMobile, which trades around $110 per share. With approximately 390 million fully diluted shares outstanding, that puts the market cap above $40 billion. Management is guiding for $150 million to $200 million in revenue for 2026, driven by 45 Bluebird satellites. Each satellite is estimated to cost around $21 million to $23 million to build, which implies over $1 billion in capital spending just to reach initial continuous U.S. coverage. A $40 billion valuation against $200 million in near-term revenue is a bet on a much larger future. The math on that bet deserves to be visible. Two fintech names, Robinhood and SOFI, are moving beyond what most investors think they are. On May 28th, the U.S. Treasury launched a federally seeded child investment account program, and Robinhood was selected alongside BNY Mellon to build and run it. Eligible children receive a $1,000 government seed contribution, with family contributions of up to $5,000 annually. That makes Robinhood a government-partnered custodian for a new generation of account holders, not a simple trading app. SOFI went a different direction on May 27th, becoming the first U.S. national bank to launch its own stablecoin, SOFI USD, directly inside its banking app for nearly 15 million members. These are structural shifts in what both platforms can earn over the next decade. Nvidia jumped about 6% on Monday after the company unveiled a new chip designed for AI-enhanced personal computers. That move was enough to keep the Nasdaq above its previous record and offset the oil drag. But this is also the concentration problem in plain view. A single name moved the index. Outside the AI core, much of the market was not participating in the same way. That is fine when Nvidia is delivering. It becomes a problem quickly if the name stumbles. While the U.S. keeps hitting records, Canada has entered a technical recession. GDP growth came in at negative 0.1% in the first quarter, following negative 1.0% in the fourth quarter of last year. 2 consecutive quarters of negative growth is the definition. This matters for U.S. investors because it sharpens the divergence between U.S. growth resilience and its northern neighbor. The Bank of Canada faces the same sticky inflation, but cannot raise rates without deepening the downturn. That is a signal worth watching for anyone tracking the dollar and North American cross-border trade flows. The look-through trade gets tested fast. Broadcom reports on Wednesday, June 3rd, with analysts expecting earnings near $2.40 per share on roughly $22 billion in revenue, representing about 47% year-over-year revenue growth. Ciena follows Thursday morning, with consensus calling for approximately $1.46 per share, 1,000 jobs added in May. That is a thin margin for good news on the labor side. The takeaway from June 1 is not that the rate problem went away. The 30-year hit 19-year highs 2 weeks ago. PPI is running at 6% year-over-year, and Iran just showed how quickly oil can move back above $90. The market is choosing to look through all of that because earnings are real, and the spending cycle is broader than one chip company. But the look-through trade has conditions. Broadcom and Ciena need to confirm that the infrastructure build-out is reaching the next layer. Payrolls need to stay out of recession territory, and oil needs to stop climbing. The rate tax is not gone. The market just decided not to pay it yet.